One of the biggest questions I get, whether I'm on YouTube, my TikTok, or Instagram, is I don't know where to find money to invest in real estate. I don't have money myself, and I don't know where to go look to find other people's money. And it's one of the easiest answers possible I'm going to talk about in this video. The easy source I'm talking about, funny enough, is called hard money lending. It's definitely not hard. They should change that name. It's super, super easy. So who are hard money lenders? Hard money lenders are companies that are in business. The sole purpose of their business is to lend money to investors like you and I. They lend money to brand new investors, and they lend money to seasoned investors. They lend money to people who want to buy a house, fix it up, and then sell it or keep it as a rental. So that's who they are. In the rest of this video, I'm going to talk about why they exist, why you should use them, and where you can find them. I'm even going to show you how to look at deals through the hard money lender's lens so you can understand how to more effectively use them and build relationships with them. There's three main reasons why they exist. The first reason is traditional banks, traditional funding sources are just too slow. They take 30, 45, maybe 60 days to close on a loan on a traditional type of deal. These type of investment properties that you're already running across or will run across, these sellers want to sell now. There's a reason why they're selling their property at a discount. Most likely there's issues with the house, but there's potentially probably issues with them or something going on in their life as well. So they're gonna want their money much less than 1, let alone 2 months. So the quickness of using them is the first reason why they exist and why you should probably use them. The second reason is these traditional banks, kind of the other funding source that most people think of if they don't have cash, they do not want to lend on deals that you're gonna be coming across if you're an active real estate investor. These big traditional banks want little to no risk. Hard money lenders don't want risk either, but they're definitely willing to take on more risk than these traditional banks. These traditional banks only want to lend money on an extremely safe deal. And a safe deal to them is a deal or a house that's passed inspection, that's lived in, either by you and your personal house, hence a normal residential loan, or a house that is lived in by a tenant. And most banks don't even want to deal with tenants anyway, so that's not even an option. But as far as lending on the purchase and fix up of a property, these traditional banks don't want anything to do with it. It's too risky for them. They already want the house fixed up. And that kind of leads me to the third reason is you can't scale with traditional banks or traditional type of lending. Even if these traditional banks do want to lend on a deal to you, which they probably wouldn't just because of the condition most likely of the property you're going to be buying, you cannot scale with them. They look at you personally, hence a traditional personal type of bank or traditional personal residential type mortgage. They're going to look at you personally. Even if you make good money, they're most likely not going to lend you a second, a third, and a fourth type of property. So if you use a USDA loan or a FHA loan or a VA loan or some of these low down payment loans, you cannot scale with those loans. I don't know all the intricacies and don't want to go over them of those type of loans, but I know most of them you can use one time or once every several years. You can't use them at any type of scale. If you're wanting to buy or flip, 2, 3, 4, 5 properties a year or even more, you're not going to be able to do that the traditional route. So why use them? Number one is they can close fast. Most can close, I would say, realistically in 2 weeks or less. And like I said earlier, these people in these houses you're going to be buying need a lot of work or need some type of work. And these sellers, there's something issues with the house and potentially them too. They want their money quickly. They're going to agree on a price with you, so you're providing a service, but they want their money now. I would say most hard money lenders can close in 2 weeks, some much, much less. Realistically, probably 7 to 14 days. However, if you develop a relationship, which I'm going to talk about a little bit later, kind of one of the pros of that, but if you develop a relationship, they can do it even quicker than that. We have a local hard money lending company here in our office, and they just did a deal last week that they funded in 2 days. They do nothing about the deal. The buyer's funding fell through, so they came to us, they had to close in 2 days, and our lending company made it happen in 2 days. That won't happen with a traditional bank. The second reason is they don't care as much about the condition of the property. They understand real estate investing. Hard money lenders, this is the entire space that they deal in. They're used to dealing in this space. They understand that the house is going to need work. These traditional banks are going to, want everything to be able to pass occupancy or, be safe. Or if it's an FHA loan, there's additional inspection. Those type of, red tape you have to go through or things you're going to have to eventually hoops you're going to have to jump through. These hard money lenders are not worried about a house that needs work. They understand that and they expect that. The third reason, and the number one most important in my opinion by far, so a big number one is going to be here, is they heavily weight the approval of the loan on the quality of the deal. These traditional banks are looking at you. They don't really look at the deal, even if they do, which again, they wouldn't, most likely, but these hard money lenders look at the deal. Even if your credit score is not the best, and even if you're not bringing any or little money to the table, we'll kind of get to the intricacies, I said it right, in a minute on this video. However, they are going to look at the quality of the deal much more than you. Obviously, they're gonna look at you, make sure you have some experience or look like you know what you're gonna do if it's your first deal, because hard money lenders lend to first-time borrowers all the time, but they're gonna look at the quality of the deal and not necessarily you. If you don't have a ton of experience and your credit score is not the highest, it's still decent, they'll look at it and then they'll really look at the deal next. After they say maybe to you, they're gonna look at the deal. If the deal is a home run, for this example, let's say you can get it for 100 and it needs 25 grand, so not a huge rehab, and it's worth 215,000, they are probably going to approve that loan even if you don't check all the other boxes, because they don't want to have risk, but they want to do loans. They understand there's not a ton of risk in that price house with that amount of rehab that's worth that much. There's a big spread on the other hand, so they're going to, potentially approve you when another funding source would not, because they look at the deal and they understand real estate investing. The fourth reason, and kind of the number one most important A, we had one and one A, is they're a second set of eyes looking at the deal. I just mentioned, they're gonna look at the deal, A, to make sure it's a good deal to approve you, but it's a second set of eyes. It's almost like having a partner on the deal. They're gonna, we're talking about local and national here in a minute, but they're gonna look at the deal. If the deal makes a ton of sense, they say, yeah, let's do it. You probably have a good deal because they understand investing and they most likely understand that area and they understand rehabbing. However, if they look at it and it doesn't make sense to them, or they want you to bring money to the table because they don't feel like it's worth what you think it's worth, or it needs more than you think it needs, that might be a red flag to you to hopefully get out of the contract if you have a contingency, or maybe try to get the seller down a little bit more to make it a better deal for you and for the hard money lender. So they're just basically a second set of eyes. The fifth reason is, if you don't have a ton of money, they're definitely still an option. Some hard money lenders will only require 10% down or less. Traditional routes are going to be 20% down or more. Some hard money lenders will require that, don't get me wrong, but there are a lot of them that require 5% down, 10% down, or even zero money out of pocket if you're buying a good enough deal. We'll talk about here in a second, but they are going to not require much, if any, down, especially after you develop a relationship. I see it all the time. I talk to my students, across the whole country. Oh, this hard money lender is requiring 10% down on this deal. I got it, but you said I could do no money out of pocket. My answer is always, do it on this deal, gain their trust. Next deal, try to put 5% down. Next, try to put 0% down. Or you can go from 10 to 0, or the numbers can vary depending on the deal and the lender and the borrower. But most of the time, no matter where you start, whether it's 20%, 15, 10, wherever it is, you can usually work that down as you do more deals to no money out of pocket, or if it's a good enough deal, like I talked about in the last couple steps, a lot of them will let you do it with 0% down. There are a couple drawbacks of using hard money lenders I did want to hit on before I talk about where you can find them. The main drawback is they're more expensive, definitely, than banks, and usually more expensive than private money lenders or other funding sources, or home equity lines of credit, or however else people fund deals. There's a ton of different ways. Hard money lending is usually the most expensive. Now, their rates kind of vary, but in general, I would expect to pay 10 to 15% plus points. Let's kind of work our way back. Points are basically cost of doing business and basically how more than likely they make their profit. So if you're borrowing $100,000 and they charge you 2 points, that means at the end of the deal, usually, once you close on the sale or close on the refinance with a rental property, you're gonna have to pay $2,000. It can come out of the deal, it can come out of profit most likely, most of the time, but they're gonna charge you 2% or 2 points, 1 point is 1% of the entire amount that they lend you. Now, the rates are a little bit higher and they vary like crazy, so I don't want to go over 20 examples, but they're usually that 10 to 15% like I mentioned. So you can imagine paying 12%, it's annualized, but paying 12% plus 2 points, that can add up on the deal, and that can be a big expense out of the deal. So a lot of people, you kind of, lift their noses at it. I don't think that's the way you do it, but that's the way I do it. Kind of, flip their noses up. I'm not going to borrow money. I don't want to pay somebody that much money. But if you don't have money, would you rather pay a little bit extra and actually do a deal? And maybe instead of making 50, you made 35? Or would you rather just not do the deal because you don't have the money? You know, whether you have the money or not, I think it's good to start to develop a relationship with a hard money lender so you have multiple funding sources. Even if you have your own money, you're eventually going to run out. So, you know, it's just kind of a cost of doing business. I don't worry too much about it. And, you know, I look at it as I'd rather, you know, pay 15% on this money and get this deal done than not do the deal and not make any money. So I just look at it as a cost of doing business. And when you're analyzing your deal, if you build it in, if you think it needs a $25,000 rehab, but you're gonna have to borrow money, well then put that in the rehab. Say it's a $30,000 rehab, say it's a $40,000 rehab, whatever that number looks like that you think you're gonna have to borrow money at, just add that in there. So that $25,000 rehab becomes a $35,000 rehab because of the money cost, because you should be putting that in there anyway. So just buy assuming that money's gonna be a little more expensive, and maybe you buy a little bit deeper, and maybe you'll buy deep enough where you don't have to come out of pocket at all on the initial down payment. The second kind of negative, and I'm spinning it as a positive, is they usually want a little bit shorter terms. They're usually gonna want to loan you the money for 6 months or less, potentially 12. I would say to be safe, they're gonna want their money back in 12 months or less. Now, you should be able to do a rehab in that time, so that shouldn't be an issue, but it kind of forces you to do quicker rehabs. I like them when they say 6 months or less, because that forces you, whether you're experienced or new, especially if you're new, to do smaller rehabs, to get in and out quickly, to do cosmetic type rehabs. You know, doing a $25,000 rehab, you know, maybe you're not gonna make as much because you're not, you know, adding as much value, but a lot less can go wrong than a $100,000 rehab. And the $100,000 rehab probably is gonna take 6, 7, 8, 9, 10 months, and the hard money lender doesn't like that, or they'll charge you more points the longer you go. So it just kind of forces you to get in the correct lane. In my opinion, especially for new investors, that lane is those quick in and out rehabs. You're not gonna make maybe 150 grand, but you can make, you know, 30, 40, 50, 60, whatever it is, 20,000, whatever it is, you can make a lot of profit on those quick in and out deals. And there's less risk for you, a lot less can go wrong, and the hard money lender will be much happier. Finally, where do you find them? This is the easiest part. You get on Google and you type in hard money lenders. Now there's gonna be some national ones that pop up and some local ones. Kind of briefly talk about the national and the local. So these national hard money lenders usually are bigger brands, bigger companies with deeper pockets. Now they're not as familiar with their market usually. They're maybe usually a little bit slower to fund, but their interest rates are probably gonna be a little bit cheaper. So they're super easy to find. You know, you can type in Google national hard money lenders, or just, you know, Google hard money lenders, and they'll probably be the ones in the ads at top, or they'll be the ones that pop up. However, I suggest digging a level deeper and just using or focusing on local hard money lenders. They're probably gonna be a little bit more expensive, but they understand the market. So when you're analyzing the deal and they're your second set of eyes, they are going to be, you know, analyzing it properly, and they're gonna know a good pocket versus a bad pocket, and they're gonna know kind of how much materials cost there. They're just gonna be so much more honed into that local market because they do a ton of deals there locally, that they're just gonna be a better partner on the deal. They may be a little bit more expensive, they may not, but kind of like I said earlier, you know, our local hard money lending company funded the deal in 2 days. Banks will do that, and I don't think national hard money lenders will do that. So paying a little bit more now to develop that relationship can pay a ton of dividends in the future. So I wouldn't worry as much about those rates. I would focus on developing relationships with local hard money lenders. And finally, if you're comparing a national hard money lender and a local hard money lender, you could potentially get more money from a local hard money lender. Here's what I mean. So let's say you think the property is worth $100,000 and it needs $25,000 worth of work. So a local hard money lender will lend you, let's say, up to 75% of LTV, which is loan to value. Meaning, if it's worth 100, they will lend you 75,000. So if you buy it for 50 and it needs 25, they will potentially, you know, if you develop a relationship, or, you know, just if that's what they do, they will lend you $75,000, meaning you're not going to have to come out of pocket to put anything down on the property. That's awesome if that's what you're looking to do, not use your own money very much. Now, before I talk about what a potential, you know, national lender would do in that case, know that even if you don't have to put money down, usually you will, especially at first, you're going to most likely have monthly payments to these hard money lenders. That's another drawback I did mention earlier. Kind of assume most of you figured that out or knew that, but you're going to have to, usually have to pay monthly payments. It kind of varies depending on your interest rates, but just know each month you're gonna have to come out of pocket a little bit, even if you didn't put anything down on the deal, to kind of help pay them and help have some skin in the game. Now, onto that deal. With that national hard money lender, They're more money, but potentially not as risky and don't know the market as well. So if they say that house is worth $90,000 rather than $100 because they don't know the area as well, and they're willing to lend you 75% just like the local person, they're only lending you $67,500, which is not the end of the world, but if you don't want to come out of pocket at all or as little as possible, you know, that's $7,500 difference because they don't know the area as well. So even if the rates are a little bit better, they might not even lend you as much. Hopefully that didn't confuse it too much. Just kind of wanted to point out the benefits of a local company for your relationship, and they understand the market better and potentially will give you more on a deal if it's kind of, you know, iffy on what it's going to be worth. They understand the market better and they probably will be more likely to lend you more money. Hopefully you learned a little bit on this video. If you have not hit that like button yet and you're still watching, please hit that like button. At least you got some value out of this. And if you did, make sure to hit that subscribe button as well and notification bell. I go live on YouTube and answer videos once a week. I release at least 2 videos a week as well. So if you want to learn more about real estate, this channel can help you, I promise. So like, subscribe, notification bell. See you on the next one.